Have you ever felt a tremor run through the floorboards of the world? A silent vibration that something fundamental just broke, while everyone else keeps watching the show on the main stage? We're trained to watch the obvious spectacles, the flight decks of aircraft carriers, the parades of military hardware, the stern speeches from podiums. But these are props. They're for show. The real decisions, the irreversible moves that lock in a future of conflict, happen not in the glare of camera flashes but in the shadowy silent vaults of central banks. If you want to know a nation's true intent, don't watch its soldiers. Watch its accountants. Because there is one asset that tells no lies, that cannot be deployed for a weekend exercise and recalled on a whim. It is sovereign debt. It is heavy, deliberate, and agonizingly slow to move. When a country decides to offload the debt of its primary rival, it is not a tactical adjustment. It is a strategic evacuation. And right now, the data reveals a financial exodus of such staggering scale and urgency that, in my view, it can only be interpreted as a superpower clearing the battlefield before the first shot is ever fired. Let's talk about a document so boring it could cure insomnia, yet so critical it might as well be a declaration of war. It's the U.S. Treasury International Capital Report, the TIC. The latest figures confirm a trend that polite circles in finance have been desperately rationalizing away. China's official holdings of U.S. Treasury bonds have not just declined, they have been gutted. As of the most recent data, they stand at roughly $688 billion. Now, to the untrained ear, that still sounds like an unimaginable fortune. And it is. But context is everything. This is the lowest level of Chinese ownership in over 16 years. We have effectively erased nearly 2 decades of financial entanglement. To understand the sheer magnitude of the retreat, you need to rewind. At the peak of the so-called Chimerica era, Beijing held well over $1.3 trillion of our debt. They were the engine that funded American deficits, recycling their trade surplus into our bonds, creating a closed loop that kept our interest rates laughably low and the global gears turning. That loop is now severed. They have liquidated almost half of their peak position. They have sold over $600 billion in U.S. IOUs, but the amount is only half the story. The context of the sale is what turns a financial transaction into a 5-alarm fire. Think about the recent period in the bond market. It has been a bloodbath. Interest rates have been volatile. Bond prices have been depressed. Selling in this environment isn't just moving assets. It's accepting a massive realized loss. You do not do this unless you are in a dire liquidity crisis, or you believe the asset in your hands is about to become radioactive. We know China is not broke. Despite domestic troubles, they are still a trade surplus behemoth, swimming in foreign cash. So the first option is off the table. That leaves us with the only other logical conclusion, and this is where my own speculation takes hold based on these cold numbers. The Chinese Communist Party has made a supreme strategic calculation. They now view the U.S. Treasury bond not as a store of value, but as a strategic liability, a hostage, waiting to be taken. You must view this through the lens of February 2022. When Russia moved into Ukraine, the West executed a financial shock tactic. They froze, with a few keystrokes, $300 billion of Russian central bank reserves sitting in Western financial institutions. Moscow thought those funds were safe, neutral assets. They were wrong. Beijing watched this, analyzed it with cold precision, and realized a terrifying truth. In a confrontation over Taiwan or the South China Sea, their trillion-dollar hoard of U.S. debt would not be an asset. It would be a weapon turned against them. It would be instantaneously frozen, seized, or reduced to zeros on a screen. So, they are getting out. They are liquidating with what I can only describe as extreme prejudice. They are willingly swallowing losses of 10, 15, perhaps 20% on the face value today, because in their calculus, that is preferable to a 100% confiscation tomorrow. This isn't portfolio management. This is financial triage. They are performing an amputation to save the patient, and the patient is their strategic autonomy. This has earth-shattering implications for America. For 2 decades, we enjoyed a magical reality. We could spend far beyond our means because there was always a hungry, price-insensitive buyer on the other side of the Pacific, gobbling up our debt to manage their own currency. That buyer is now the biggest seller. They have flipped from the principal funder of American excess to the principal source of a coming supply glut. This creates a terrifying question. Who fills that void? Basic economics says that when the second largest holder dumps this much supply onto the market, prices should crater and interest rates should scream upward. That would trigger an immediate economic heart attack here. Mortgage rates would detonate. Banks would buckle under the weight of falling bond prices. The cost of servicing our national debt would become utterly unsustainable. And yet, that hasn't fully happened. Rates are up, yes, but the market hasn't collapsed. Why? Because as China steps off the ledge, someone else is being pushed forward to catch them. Look deeper into the TIC data. While China's line plummets, other entries are ballooning to bizarre, historically unnatural levels, specifically the United Kingdom and Belgium. The United Kingdom's holdings have surged to over $750 billion, making it nearly tied with China as a top foreign creditor. Let that resonate. The British economy is a fraction the size of China's. Britain runs a trade deficit. They do not have a natural organic surplus of dollars to invest. So where is this money coming from? The inescapable thought, to my mind, is that this is not free market investing. This is geopolitical arm twisting. London is being leveraged, likely through the financial engineering of the city, to act as a shock absorber for the U.S. Treasury market. Then there's Belgium, with holdings around $350 billion. Is Belgium suddenly an economic powerhouse? No. Belgium is home to Euroclear, a key piece of the global financial plumbing. These holdings often represent custodial accounts, a layer of anonymity for other actors. The simultaneous surge in UK and Belgian holdings as China exits screams of a coordinated political operation. I'm calling it the Bag Holder Alliance. Washington is telling its partners, if you don't step in and buy what China is selling, our market breaks. And if our market breaks, the entire Western financial system goes with it. It is a form of quiet financial conscription. We are cannibalizing the balance sheets of our closest allies to plug the hole left by Beijing. But here's the fatal flaw in this strategy: capacity. China had a near infinite capacity to buy because they were paid in real dollars for real goods. The UK and Europe do not. They are already straining under their own debt, slow growth, and energy crises. By forcing them to fund us, we are draining the vitality from our own support system, weakening the pillars of our alliance to keep the central dome from collapsing. It creates a house of cards of terrifying fragility. This is the point where I have to stop and emphasize. This is my analysis, my reading of these dry data points into a narrative of alarm. But the connections seem too logical to ignore. And if you're seeing this pattern too, the silent financial war playing out behind the scenes, then you understand why channels like this one exist. We connect these dots so they don't get buried in the noise. If this perspective is valuable to you, becoming a part of this community is the best way to ensure it continues. Now let's follow the money. Because when China sells a U.S. Treasury, they get U.S. dollars. But they don't want dollars. That's the whole point of the exit. So what are they doing with the proceeds of this $700 billion fire sale? They are not parking it in another currency. They are executing history's most aggressive pivot from financial assets to physical assets. They are trading paper claims for tangible reality. They are buying, and I mean buying, 4 critical things. First, gold. Month after month, the People's Bank of China is a relentless, silent buyer on the London and Zurich markets, shipping the metal east. Gold is the ultimate anti-dollar. It sits in a vault, has no counterparty risk, and cannot be frozen by a sanctions clerk. They are building a collateral-based fortress. Second, energy. China imports most of its oil, a profound vulnerability. Their response? Fill every conceivable tank, cavern, and newly built storage farm to the brim. They are buying record amounts, often from sanctioned states like Iran and Russia, building a strategic petroleum reserve so vast it could let them weather a naval blockade for months, if not longer. The cash for this? It's coming directly from the liquidation of those U.S. bonds. Third, the metal mountain. This, to me, is the most telling signal. China's property sector, once the world's biggest consumer of copper for wiring and pipes, is in a depression. And yet, their imports of copper ore remain at staggering near-record levels. Why? If you're not building apartments, what are you building? The answer, in my speculative opinion, points to a shift in economic priority. Drones, munitions, the green energy grid to ensure wartime energy independence. They are cornering the physical markets for the raw materials of 21st century power. Fourth, the food fortress. With a vast population and limited arable land, food security is a paramount vulnerability. China's response has been to quietly accumulate a dominant share of the world's grain reserves. They hold enough corn and wheat to feed their nation for well over a year without a single import. They are trading bond yield for calories, financial return for survival. This is the masterstroke, and it explains the losses Western economists mock them for taking. Beijing does not care about a mark-to-market loss in fiat currency terms. They care about strategic security. If selling a bond at a 20% loss provides the cash to buy oil that will keep their navy running when the Strait of Malacca is closed, that is a winning trade. They are exchanging fake electronic wealth that can be vanished with a keystroke for real wealth that can be burned, eaten, or fired from a cannon. The implications for the average person are profound. The foundational rule of modern investing, that the U.S. Treasury bond is the risk-free asset, the safe ballast for your portfolio, is now a fairy tale. That bond has become a geopolitical football. Its stability depends on the willingness of reluctant allies to bankrupt themselves for our benefit. When that willingness frays, the collapse will be swift. So, what do? You must think like they are thinking. First, shorten your horizons. Dump long-term treasury bonds. They are the most vulnerable to the supply tsunami China is unleashing. If you need safety, stick to short-term treasury bills, cash equivalents that aren't locked in for decades with a government fighting a financial war. Second, follow the smart money into things. China is selling paper to buy stuff. You should consider the same. Gain exposure to the producers of the physical assets they are hoarding. Energy companies, copper miners, gold. In a world where the response to a broken debt market will be the printing of trillions more dollars, you want to own the stuff the currency buys, not the currency itself. Finally, watch the canaries in the coal mine, the Japanese yen and the British pound. These are the currencies of our primary bag-holder allies. If they begin to buckle under the strain, if the yen crashes toward 160 or the pound shows severe stress, it is a signal that the alliance is fracturing under the financial weight. That is the moment the entire artificial stability could vaporize. The $688 billion figure is not a statistic. It is a countdown. Beijing is methodically, deliberately severing a primary artery of the global financial system. They are willing to endure financial pain today to guarantee sovereign survival tomorrow. Do not mistake the current, engineered stability of the markets for safety. It is the calm of a theater after the audience has been told to evacuate, but before the lights finally go out. The divorce is final. The assets are being divided. All that remains is for the rest of the world to realize the house is already on fire.